Hello, this is Richard Posson, President of Ag Financial Strategies, the presenter of the Posson Model Business Cycle Report. And I'm going to give you a brief explanation of the service. When you log into the service, either from free trial or as a subscriber, meaning we allow the 2-week free trial people to access the full site, they'll see the whole service. What you will find is that we offer videos that are normally updated Monday and Thursday on something like 8 market sectors. They can include like the energy markets, agriculture, metals, interest rates, dollar index, stock indexes. And then on Tuesday and Wednesday we may include some videos that update, say, the economy, the macro, perhaps even a micro picture, perhaps something on climate, as we have a cycle model for climate, temperature, and precipitation studies. And also on Tuesday and Wednesday, we can include some PDF files that are a chart book, which we call the Fast Track Report, which would be the same or similar charts that we show in the videos, but there's little to no commentary. We're just showing the charts. And this is for people who want yet an additional update beside the videos, or they are in a hurry, don't want to watch the video, and they can just pull up this chart book, this Fast Track Report, and just take a quick look at the charts to see, did we change anything in terms of our model forecast. And then we're going to offer a one-way blog that will allow us to offer notice of what we have updated, as well as maybe some alerts of maybe the model has changed opinion or assumes that a trend has come to an end. Now, what we're providing is a business cycle model that relates to a type of cyclical analysis that begins with time cycles, but we're then trying to put them into a clock perspective or characteristic. And what this means then is we can take a very short-term cycle that might be represented like a second hand on a clock, and obviously there's a series of seconds that build into a minute hand, which is your next larger cycle, and then there's a series of minutes that build into the next larger cycle, which is an hour. We've actually studied some markets and learned that we can find cycles as fast or short-term as 1 second. And they can create uptrends and downtrends lasting a fraction of a second. Now, this would be for the most active markets like stock indexes and some commodities. Now, we've learned those cycles build into larger and larger trends such that people do business during the day on 13 different types of cyclical trends. And they also do business on an intra-week basis, which we call a level 4, very short-term trend. And then they build that into intra-month type of business, which we call the level 3. And the level 3 is where our service begins, even though we will discuss something of level 4 from time to time to give you an idea of what we expect for a day or the next day. We will not be discussing the still faster intraday trends of level 5 on down to level 12. The level 3 assists people during the course of a month for the better purchase and sale during the course of a month, or at least to have knowledge what can go right or wrong with their investment or their hedge. Now, what we also do is we build those level 3s into level 2s and level 1s, and those are minor, major, intermediate, intra-year trends. They will last a few months to several months. And then they build into the smallest long-term cycle called the 3-year business cycle, which can make or break your business and investment year. So our followers are mostly interested in the level 3, level 2, level 1, and the 3-year business cycle. But occasionally we'll discuss level 4, and then we, more frequently than the level 4, we will discuss long-term to super long-term. We have discovered cycles of not just 3 years, but 9 years, which is a major long-term. And then we have 3 super cycles that can build into multiple decades all the way out to centuries. Goes as large as a 216-year cycle that relates to a 70-year to 140-year bull and bear market trends, which we think is the true 100-year bull and bear markets you may hear other analysts talk of. Now, the chart I'm showing you here is a daily bar chart. We use this to show the short-term trends. What you can see is each black little bar here is showing the open, high, low, close of the day. And what you can see is every few days, it's popping and dropping. It's fluctuating. It's a little heartbeat. Those are the L4 interweek trends that build into larger L3 up and down trends, which are the larger trends during the month, the more important trends. As part of the service, we try to set not just a time objective, meaning when what dates do we think, or the amount of time we think for a bottom. But we also use other studies, which can be economic, fundamental, qualitative, valuation kind of studies, but we can also use technical studies and quantitative studies that come up with statistics of how far price can move. And we also know the history of these trends, in other words, the statistical performance. And we blend that together to come up with a price objective that we can put with the time objective, and then wind up drawing a little window of reversal on the chart of when we anticipate a bottom. You can see this market came down into that window of reversal, turned around, and went up. You can see it found a bottom here. You can see the model came right to the minimum objective but for price and the maximum objective for time. The market just touched it, sold off, and came down in this window reversal. We're now forecasting a rally, but a meager, weak rally into the next L3 top, and then it'll decline in the next L3 bottom. Now, we normally include a little bit of technical analysis as well, such as some favorite moving averages that you can see work quite well for this market. We'll show some momentum indicators of when it's overbought or oversold. Basically, what we're saying is when it comes into a window reversal, if it was trending down that window reversal, it's undervalued, oversold, it's time for a pop at least. When it's trending higher into a window reversal, we're saying it's overbought, overvalued. Start looking for some negative news to come out. So this can give you a clue when then anticipate a fluctuation of supply and demand, a fluctuation of human behavior in the markets and in business, a fluctuation of other business statistics. And so therefore you also want to look for a change in news. So it kind of becomes a detective tool. Now, if we zoom out to a weekly chart, so each one of these bars is now 1 week, Monday through Friday, and showing you open, high, low, close of the week. What we're doing is compressing those L3 trends so that they now look like only a few bars, a little pop and drop, whereas they look pretty important on the daily chart. We're doing this so we can better see the next larger trends, which are L2 and L1 trends during the course of a year. And we also draw windows of reversals for these. The bigger the trend, the more time it's going to trend, and the greater the price change, and the more important it is to your business and investment. And you can see the model did a pretty good job of calling a top here, bottom here, top here, bottom here. And what it's representing is a more important change of supply and demand. Sure, supply and demand was fluctuating off those L3 trends day to day, week to week, but it was also fluctuating on a much grander scale, larger scale of time and price performance. Now we can also zoom out by an additional amount by using a monthly chart, and we can show the long-term 3-year business cycles. And we can see we had a 3-year business cycle top here, came down at the bottom, we took a shot at forecasting a bottom, it rallied into a top, took 2 strikes to find the top, rallied into a bottom here, and now we're bullish this particular market long-term. Now I'm going to switch to a different charting program. And this is a yearly bar chart. It happens to be of corn. It goes back to year 1800. And we have studied various markets going back as much as even 1,000 years. And we can see that there's larger cycles like 36-year cycle bottoms, 72-year cycle bottoms, 216-year bottoms. And these relates to depressions, wars, famines, droughts. And you can see how the market fluctuated all during the 1800s. Well, in the 2000s, we made a forecast that a super cycle bottom was coming in place, and expect a record rally to a new record high price no later than 2008, and there it is, 2008, huge explosive bull market. And you can see those cycles break down to even cycles per decade of 9 years, up, down, up, and then we can break it down into the 3-year fluctuations. We just showed you on a monthly chart where it took several months. Now we're showing it only takes like about 3 to 4 years for each little fluctuation of that 3-year cycle. So we have a very unique form of analysis here where you can provide a much greater detail from very short term to very long term than a lot of other analytical companies. Now we don't study just price. We look at things like unemployment, where we've learned that unemployment rate peaks every 9 years, and that coincides with another indicator that we call the eco-trend indicator that suggests the economy grows for 7 to 12 years, then it slows as well as has a recession for about 1 to 3 years, creates like an 8 to 13-year bottom, and it's actually a 9-year cycle bottom as well as a 9-year cycle top to put an end to the boom phase. Now that indicator is made from the PMI indicator, which is quite famous, and that's the Procurement Manufacturing Index, which is used by many economists. We use that as well. We also look at nominal GDP per capita, and we have that going all the way back to year 1800. But you can see unemployment is cyclical. We have 9-year cycle tops and bottoms. That gives us a clue of where the economy is going. Now we also look at things like real estate. So we don't have to look at mainstream, very active markets. Here's real estate REITs. Now the real estate REIT doesn't like to bottom necessarily at 9-year cycles by themselves. It tends to bottom at an 18-year cycle, combining 2 9-year cycles. A little bit different than our economy. Our economy really likes 9-year cycles. Stocks and commodities like it. Real estate says, I'd rather trade every other one. And look how real estate rallied, pulled back into a 9-year cycle bottom that was an 18-year. Then we had the next 9-year, which doesn't mean much. Rallies up here, and then it crashes for the 2008-2009 financial crisis, Great Recession, and puts in not only an 18-year cycle, but larger 36 to 72-year cycles, and then it just rallies briskly out of that. Now we also go and look at things like climate. And in year 2000, I did research for a startup climate exchange firm. They were actually going to trade temperature and precipitation in index form, and I learned that the indexes convert weather into something that looks like a stock and commodity, and we can study them that way and trade them even from a technical manner. But you can also study it just from the raw data. This is precipitation, and we made a forecast that somewhere around 2010 to 2012 we would see a collapse in precipitation for the US, and you can see we got it. This led us to believe that there was also going to be a spike higher in temperature, and you can see we got it. Higher than even the 1930s Dust Bowl. It also led us to believe we were going to have a serious crop problem during that time frame. And in 2012, we got a serious crop problem. Corn and soybean crops were greatly reduced due to this drought. So I want to show you that we not mostly look at prices. People are paying us mostly to study price. But it's interesting that we can find cyclical behavior in nature, and not just cyclical behavior of human beings and how they run their businesses and how they make investments. So we think we run a very unique analytical service. It has a timing aspect to it. It has a trend following aspect to it. And I think you're going to find that we'll either fit on your list of other advisors, consultants. In fact, I wouldn't be surprised to say our service will be at the top of the list of your advisors or consultants. Or if you're doing your own analysis, you may very well learn, you want to use our service in the sense that you can at least watch for those windows of reversals and then make your own decision, come up with your own buy and sell signal from that. Keep in mind the site offers videos, chart books, and then we're going to have a blog with an update, and we may link this to, say, a Twitter private account where we can also offer updates, and we'll be doing some email updates. You should seriously consider giving at least a 2-week free trial and maybe sign up for our monthly based service and then let it run for a year. And I think you're going to find we deserve to be at the top of the list of your advisors and analysts. Thank you.